If you're looking to predict just where the future of the stock market is going to be going in the next few months, you do not need a crystal ball. You can instead look at a chart like this. Now, this chart has actually predicted most of the last big financial crashes. You can see here that in 1989, before Black Friday happened, which is this golden line here, the blue stuff that you can see actually came down below this zero line. Now, I'm going to go through exactly how all of this works in a moment. You might want to get a pen and paper to one side, or maybe watch this video a couple of times, because there's going to be a lot of information that if you are a trader, particularly like a retail trader who doesn't really understand the market, the economy, what's going on, this is the video for you. So every one of these little golden lines, this one here being 2000, so that would be the dot-com bubble, this one over here 2008, and this one just recently, this was actually the COVID virus. Now you can see that although the blue stuff that you see here got pretty close, we didn't actually come down below. Now this is vitally important right now, because you can see that right now we are very much below. So are we on the precipice of a major financial crash?
Lehman Brothers staff arrived at work in London this morning to be told the bank had been put into administration.
It is disastrous, but I think people are experienced enough and professional enough to take it on the chin.
So this chart here is Bondonomics, and it is all about predicting market moves through the art of US Treasury bond yield curve analysis. So if you're like me and you've been trading for a while, you probably have no idea how the US bond market works, because it sounds really boring and who cares about that anyway? Well, you will care once you understand how this works. First of all, you've got the federal funds rate. Now, the federal funds rate, let's say that that is 2%. So that will be cash in the bank. So, and if you can earn 2% just for holding your cash in the bank, then why would you hold a 1 month treasury bond which was worth less? Of course you wouldn't, right? Which is why the 1 month should be at least a little bit more than the federal funds rate. Otherwise, you're just not going to be bothered buying treasury bonds, would you? And that goes exactly the same. If it's 3 months, you'd expect a little bit more, and 6 months, a little bit more again, because the longer that you're holding these bonds for, you would expect to be getting a better return. Otherwise, you would just get the shorter term bonds. So in a normal functioning market, what you should see is that the longer that you're holding the bonds, the more that you should be getting each year in your annual yield. So that eventually the bond yield curve should be curving upwards, just like what you see here. Now, what we're going to do is look at some examples of some abnormal conditions, kind of like we've got now, which we were just looking at. So this here, the blue line is December 1990, which is just a little bit after something called Black Friday. Okay, now the orange line was prior to Black Friday. So this is June 1989. Black Friday actually happened in October. And you can see that prior to Black Friday event happening, the yield curve is what they call inverted. So the lower maturity yields were actually worth more than the longer term bonds, which is of course a bad economic situation to be in, because why would people invest in longer term investments with the government if they can make more money on the shorter term stuff, or just have cash in the bank? Now this one here, this is the dot-com bubble which burst. So the orange line is October 2000, which is how it looked at around the time that the dot-com bubble started to go down. Now, dot-com was actually a bit of a slower crash in the market. It wasn't just a one-day thing like Black Monday or Black Friday. It just happened over the course of about 2 years. Now, you can see that the year or so before, in 1999, the yield curve looked pretty normal. Unfortunately, when the yield curve did flatten off and start to invert, it didn't give traders an awful long time before it was crashing the market. Now, in 2008, what you had was actually 2 years prior to the actual crash. You had this orange line right here, that was December 2006, so you had tons of prior warning that something was going to happen. The blue line is from 2002, when everything was rosy, everything was great. You can see you got a fantastic yield curve there for the US Treasury bonds. Everything looked great. But by 2006, well, December 2006, you can see the writing was on the wall. Now in 2007, you had Northern Rock fall in the UK. You had a bunch of different banks crashing out in America. They all fobbed it off. They said it was all fine. Obviously, 2008 came. It wasn't fine.
The signs were everywhere, but now it's official. We are in a recession. The research group that makes that determination made it today and said the recession actually started a year ago.
And this is where we are right now. Similar story. Everybody's telling you everything's fine. You turn on the news. Yeah, things look bad, but it isn't that bad. Well, that's the bond yield curve, which looks pretty bad to me. I'm not sure how it looks to you, but it's actually been pretty bad for some time now. Now, how that chart works that you saw earlier is by taking the 10-year yield and the 2-year yield. So in the case of the inverted curve up here, which is the problem, you take the 10-year and you minus the yield of the 2-year, which because the 2-year is actually higher than the 10-year, this will give you a minus figure. Whereas on a good healthy year, because the 10-year yield is more than the 2-year yield, you actually end up with a positive number, so that you can clearly see on the chart here that during healthy years you have a positive number up here, and as soon as the bond market becomes inverted, you end up down here. So this is where we are right now. You know, you're down almost sort of like 1% down. It is very, very inverted and not looking that good at all. And I know that this crash, before you say anything in the comments down below, this was a minor crash, the COVID crash in 2020. It could have been a lot worse, but the Fed at the time under Trump, they began actually lowering interest rates prior, seeing that it was looking like it was going to invert. So they took some proactive measures there and they stopped the stock market or the bond market, sorry, from actually inverting at that time. But with a complete global lockdown, I mean, the market was going to crash. So I've got that listed on there, but yeah, I'm not sure it really is that important. Now here in 2008, you can see the main crash here. However, in 2007, everything was going pretty bad for the banks already after this inversion here. Now over here in 2000 we had the dot-com bubble, and you can see that it was inverted the entire time, even through the crash itself, whereas most of these, the inversion on the bond actually rectifies prior to the crash happening, as you can see right here. So this was 1990. We had a bit of a crash after just a tiny little inversion here on the bond yield chart, and prior to that as well you had more inversion here, followed by the 1989 Black Friday crash. This one over here, this was Black Monday. Again, you can see a small little inversion there prior to that. However, quite worrying as we go more back in time here to the 80s, you can see tons of inversion here, and although there was no actual real crash at this time, this was a period known as stagflation. So that could well be what we're looking at right now. So I don't know, guys, what are your thoughts on this? Are we entering a period of long-term stagflation, just like back in the 1980s, or are we due a major stock market correction sometime soon? Right here, you can see the NASDAQ, and we had a bit of a top here, and it came down. We just came into the pocket here of the top. Are we going to go lower, like for another lower low, or will we actually push higher? I'm not too sure. Let's go and take a look at the dot-com bubble when the bond yields were inverted for quite some time. And what we have here is something kind of similar. So we have a big ride up to the top of the bubble. It then came down, went back up, didn't quite make it to this little blue line here before the real sort of downward trend began. And that downward trend during that inversion actually took from here, so around 2000, all the way through to October 2002, so well over 2 years to actually come all the way down. However, if you bought the top of the market there during the dot-com bubble, it actually took you 17 years just to break even. And this is how the S&P is looking. So we took that big fall down here. This was during the COVID crash. It was like a mini flash crash. Didn't really last that long. Soon was going back up all the way up here. But we did falter. We came down a bit. So this red line, that you can see here, this is actually 20%. So as it drops down, that is below 20%, which would be kind of like the definition of a bear market. So when we were down there, we also had a load of quarters of negative growth in the US economy.
Yesterday, I spoke with
President Biden is pushing back against fears of a recession, emphasizing the strong job market and billions in business investment.
That doesn't sound like a recession to me.
And sure enough, things did go back positive, but they didn't move all the way up to new highs. Instead, it actually stopped out here around this blue line on the Fibonacci after falling down here into the red zone, which is not a good zone to fall down on a pullback. And so we've actually only gone this high up. Will this then continue down? And actually, is this the start to something just like the dot-com bubble of 2000? So I don't know. Let me know what it is that you think in the comments down below. Are we due a long period of stagflation or a long 14-year period to actually break even, just like the dot-com bubble there on the NASDAQ? What are we heading into? Do let me know down below. I'm also going to leave a link down in the description to that chart of the 10 minus 2-year bond yield chart, so you can take a look at that for yourself. Other than that, please do leave a like and a subscribe, and I shall see you again in the next video.